It is 1973. The floor of the Chicago Board of Trade is a chaos of men in colored jackets. They are screaming. They are waving their hands in a secret language of numbers and intent. Paper, crumpled and precious, flies through the air like confetti after a ticker, tape, parade that never ends. The air is thick with ambition and the smell of stale coffee. A voice cuts through the noise. In 1973, two economists published a paper. The paper contained a formula they'd borrowed from physics. Within a decade, that formula was being used to price trillions of dollars in financial products. By 2008, it was one of several mathematical models at the center of the largest financial catastrophe in 70 years. This is the story of how a physicist's equation changed the world, and what happened when the world forgot it was only a model. So, what is this thing? This option that caused so much trouble? It is simpler than it sounds. An option is a contract. It gives the person who buys it a choice. It is the right, but not the obligation, to do something later. Imagine you see a house you love with a price tag of $500,000. You think its value might go up, but you don't have the money right now. You go to the owner and say, "I'll give you $5,000 today. In exchange, you give me the right to buy your house for $500,000 anytime in the next 3 months." The owner agrees. You have just bought an option. Now you have a choice. If a new tech company announces its headquarters next door, and the house's value shoots up to $700,000, you can exercise your option. You buy the house for the agreed-upon $500,000 and have an instant $200,000 gain on paper. If, instead, a sinkhole opens in the backyard, and the house's value plummets to $300,000, you can just walk away. You let the option expire. You lose the $5,000 you paid for the contract. But that's it. You weren't obligated to buy the collapsing house. The option gave you all of the upside and limited your downside to the small fee you paid up front. This is the magic of an option. It is a bet on the future with a built-in safety net. Now, swap the house for 100 shares of a stock. The principle is the same. You can buy a call option, which is the right to buy a stock at a set price. Or, you can buy a put option, which is the right to sell a stock at a set price. This simple tool creates a world of possibilities. It lets you speculate on which way a stock will move. More importantly, it lets you hedge your bets and protect yourself from losses. But all of this raises the real million-dollar question. Or in this case, the $5,000 question. Why was that contract worth $5,000? Why not $1,000? Why not $10,000? That is the puzzle. The value of the option depends on things you can't know for sure. It depends on how likely the stock price is to move up or down. It depends on how much time is left before the option expires. It depends on interest rates. Before 1973, pricing this was guesswork. A trader would look at the stock, squint, and quote a price. He was pricing uncertainty itself, and for that, there was no instruction manual. There was no clear, logical, and repeatable method to find the right number. The solution came from a strange place, not from a bank or a trading firm, but from the dusty annals of academic history. It started in 1900 with a French mathematics student named Louis Bachelier. For his PhD thesis, The Theory of Speculation, he studied the movements of prices on the Paris Stock Exchange. He noticed something. The prices seemed to wander. They took a random, unpredictable walk. He proposed that the probability of a price moving up or down was about the same. It was a radical idea. His thesis committee barely passed him. His work was forgotten for half a century. Meanwhile, in 1905, a young patent clerk in Switzerland pondered a different random walk. Albert Einstein, patent clerk, pollen grains jiggling in water, Brownian motion, tiny water molecules knocking pollen about, Einstein's equations describing that random dance. The math for pollen jiggling matched Bachelier's math for stock jiggling. This connection was the key. Physics tools might be useful in finance. Heat spreading through a metal bar, the heat equation. A stock's uncertainty spreads out over time. Could the same math describe both? Treat a future stock price not as a single number, but as a distribution of possibilities, a cloud of heat spreading. This was the intellectual leap. Einstein's physics began to haunt finance departments. The equation they derived is the heart of the model. It looks complex, but each piece tells a story. It is a sentence written in the language of calculus. It describes a delicate balance. Here it is, the engine that reshaped modern finance. Vt plus 1/2 s squared 2v s2 plus rsv s RV equals 0. Let's break it down, term by term, as if we were chalking it onto a blackboard. First, V, the price of the option. The whole equation is designed to solve for V. The option's price, V, depends on the stock price, S, and it depends on the time left until expiry, T. So the equation describes how V changes as S and T change. The first term, VT, is known as theta. This is simply the rate at which the option's value decays over time. As the expiration date gets closer, there's less time for the stock to make a big move, so the option becomes less valuable. Think of it as a melting ice cube. The next two terms are the interesting ones. VS is delta. It measures how much the option's price moves for every $1 move in the stock. 2VS2 is gamma. It measures how much delta itself changes as the stock price moves. Gamma is the acceleration of the option's price. The real star of the show, however, is the term in the middle, 1/2 sigma squared S squared 2V/S2. This is the part that connects directly to random motion. The Greek letter sigma stands for volatility. It is a measure of how much the stock price jumps around. A sleepy utility stock has a low sigma. A hot tech startup has a high sigma. This term is the engine of uncertainty. It is the mathematical expression of the stock's random jiggle. It is the ghost of Einstein's pollen grain, haunting the equation. It is what makes this a financial physics problem. Finally, we have R, the risk-free interest rate. RSVS, RV. Those R terms come from earning the risk-free rate on a perfectly hedged portfolio. The whole equation sets up a balance. The decay of the option's value over time, theta, plus the effects of the stock's random jiggle must be perfectly balanced by the return you get from running your risk-free money machine. When all these forces are in equilibrium, the equation holds true. And from it, Black, Scholes, and Merton could derive a clear, closed-form solution for the price V. They had built a beautiful machine for pricing the future. A really elegant machine. In 1973, Fisher Black and Myron Scholes published their paper, The Pricing of Options and Corporate Liabilities, in the Journal of Political Economy. The timing was perfect. In that very same year, the Chicago Board Options Exchange opened its doors. For the first time, there was a centralized, liquid, and standardized exchange just for trading options. Suddenly, there was a massive new market full of traders who were desperate for a better way to price the products they were selling. The Black-Scholes formula landed like a stone in a quiet pond. At first, adoption was slow, the math was intimidating, but a few savvy traders and firms saw the edge it offered. Texas Instruments started selling a calculator with a built-in Black-Scholes button. Now, anyone could punch in a stock's price, the time to expiration, the volatility, and the interest rate, and out would pop a number, the correct price. The gut feeling of the old-school trader was being replaced by the certainty of a silicon chip. The formula was a black box that spat out money. Firms on Wall Street quickly built their own, more powerful versions. They hired PhDs in physics, PhDs in math, the quants, to build models not just for simple options but for ever more complex derivatives. The formula gave them a language and a logic for risk. It enabled the practice of delta hedging, the very strategy that Black and Scholes had imagined. A bank could sell millions of dollars in options to its clients, and then use the formula to calculate exactly how many shares of the underlying stock it needed to buy or sell to remain hedged. Every machine has an instruction manual. Every model has a list of assumptions. The Black-Scholes model was no different. To make the math work, to get that clean, beautiful equation, Black and Scholes had to make some simplifying assumptions. These assumptions were the fine print. And for a long time, in the heat of the money-making, it seemed like nobody bothered to read it. Or if they read it, they didn't take it seriously enough. The assumptions were neat, tidy, and convenient. The real world was not. First, the model assumes that stock market returns follow a log-normal distribution. Black-Scholes world, perfect bell curve, real world. Similar peak with much fatter tails. In this view, small everyday movements are common, while extreme catastrophic moves are vanishingly rare. The model says a 10 standard deviation event, a true market crash, is something you would not expect to see in the entire lifetime of the universe. This assumption is the model's bedrock. It is also, as we would learn, dangerously wrong. Second, the model assumes volatility. The sigma is constant. It assumes that a stock's jumpiness is a fixed, known quantity that doesn't change over the life of the option. Anyone who has watched a market panic knows this is not true. In a crisis, volatility doesn't stay constant, it skyrockets. The model also assumes that trading is continuous, that you can adjust your hedges at any moment without cost. It assumes there are no sudden gaps or jumps in prices, like the one that happens after a surprise announcement or a market crash. It assumes that you can always borrow and lend money at a single, risk-free interest rate. These assumptions were necessary simplifications to solve the math. Black and Scholes knew they weren't perfect descriptions of reality. They were building a map, not a perfect photograph. The problem arose when the people using the map started to believe it was the territory. They built trading systems, risk models, entire financial empires. They were building skyscrapers on a blueprint that had a quiet little note in the corner, a note that said, "Warning, does not account for earthquakes." And the earthquake was coming. The perfect, gentle bell curve of the Black Scholes model is a comforting image. It suggests a world that is mostly orderly, with occasional minor disruptions. The real world, however, has fat tails. This means that the bell curve that describes actual market returns is not so gentle. Its tails, which represent the probability of extreme events, are much fatter than the model's tails. In the real world, universe-endingly rare events seem to happen every few years. The monster in the tail of the distribution is a much bigger and more frequent visitor than the formula predicts. This is where the model is most fragile. The math works beautifully in the calm, placid center of the curve, but the money made or lost in finance often comes from the tails. A single, violent move in the market can wipe out years of small, steady gains. The model, by underestimating the probability of these moves, systematically underprices the risk of a crisis. It gives traders a false sense of security. A trader using the formula to price an option that protects against a market crash might sell that protection far too cheaply, because the formula tells him a crash is essentially impossible. People like the mathematician and former trader Nassim Nicholas Taleb began to warn about this. He argued that Wall Street was building a powder keg, relying on models that ignored the possibility of what he called black swans, rare, high-impact events that are impossible to predict from the past. The first deafening alarm bell rang in 1998. It came from a hedge fund called Long-Term Capital Management, or LTCM. If any fund should have understood the models, it was this one. Its board was a dream team of financial superstars. John Merriweather, the legendary bond trader from Salomon Brothers, Myron Scholes, Robert Merton. They had not just read the instruction manual, they had written it. Their strategy, be the smartest guys in the room, use complex models to find tiny pricing discrepancies and leverage up massively to profit from them. LTCM's models, descendants of the Black Scholes culture, they assumed markets would remain liquid. They assumed historical correlations between different assets would hold. They made bets that the prices of similar bonds in different countries would eventually converge. Then, in August 1998, Russia defaulted on its government debt. It was a black swan. A shockwave went through the global financial system. Investors fled from anything that seemed risky. They piled into the safest assets, like United States Treasury bonds. The correlations that LTCM's models relied on didn't just break, they reversed. Suddenly, all of LTCM's carefully constructed positions started losing money at once. The fat tail event had arrived. Their models told them the losses they were experiencing were so improbable, they shouldn't have happened in billions of years. But they were happening in real time. As they tried to unwind their positions, they found that liquidity had vanished. No one wanted to buy what they were desperately trying to sell. The fund, with around $125 billion in assets and an estimated exposure of over $1.25 trillion, was in a death spiral. The entire global financial system was at risk. The Federal Reserve had to orchestrate a massive private bailout to prevent a total meltdown. A decade later, the lesson had not been learned. In the 2000s, Wall Street had a new favorite toy, the collateralized debt obligation, the CDO, a complex bond made from slicing and dicing thousands of mortgages. To price the risk of these CDOs, firms used another elegant piece of math, the Gaussian-Coppola formula. Like Black Scholes, it had assumptions. It drastically underestimated the probability that thousands of homeowners across the country would all default on their mortgages at the same time. When the United States housing bubble burst in 2007 to 2008, that's exactly what happened. The models failed, losses were biblical, and the global economy plunged into its worst crisis since the Great Depression. The steamroller had arrived again. So is the equation a villain? Is this a simple story of a dangerous formula that wrecked the world? No. The story is more complicated and more human than that. The Black-Scholes equation is a brilliant intellectual achievement. It took a problem that was pure guesswork and gave it a logical structure. It provided a map for a territory that was previously uncharted. It helped build the modern financial world, its power, its flaws. The problem was not the map. The problem was the mapmaker's children, who came to worship it as a perfect representation of reality. The equation is a tool, not an oracle. A hammer is a good tool for hitting a nail. It is a bad tool for fixing a watch. The Black-Scholes model is a good tool for pricing certain kinds of options in calm, liquid markets. It is a bad tool for managing risk in a panic. The failures of LTCM, the 2008 crisis, were not failures of a single equation. They were failures of a culture. A culture that fell in love with the elegance of its mathematical models and forgot the messy, unpredictable, deeply human nature of markets. This brings up a fundamental difference between physics and finance. An apple does not care if Newton is watching it. Its fall is governed by indifferent laws. But markets are different. Markets are made of people reading the same models. If every trader uses the same Black-Scholes formula to hedge, they'll all try to sell when volatility spikes. That collective action can create the very crash the model was supposed to prevent. George Soros called this reflexivity. Observing and modeling changes the system. In the end, Black-Scholes is a lesson in the limits of knowledge. A model is a simplification, a caricature of the world. It works only while its assumptions hold. The key skill is knowing when it will break. It requires humility. It requires constant nagging awareness that the map is not the territory, and the monster in the fat tail is always waiting. The equation is not a book of answers. It is a tool, beautiful, dangerous, and to be handled with care.